All right, let's get right into it. The Federal Reserve just made their latest announcement, and, as always, the markets reacted in a flash. But the real story isn't just what they said, it's all about what happens next. So today, we're going to crack the Fed's code, dig into those hidden signals, and build an investment playbook you can use right now.
Okay, so let's really dive in here. Because every single time the Fed speaks, there are actually two messages. You've got the official one right there on the paper, and then you've got the real one, the one that's hidden between the lines. Understanding that difference, that's the key to the whole game for any investor. So what was the subtext this time? Let's figure it out.
Here's our game plan. We'll start with what they said officially. Then, we're going to decode what Powell's message really was. After that, we'll look at how the market is probably going to move, zero in on the key sectors to watch, and wrap it all up with a 5-step playbook on how the smart money gets ready for what's coming.
Right. First up, the official announcement. This is the part that everybody sees, but it's just packed with this super carefully chosen, coded language that Wall Street spends hours poring over. Let's look at the exact words they used.
So when you boil it down, the written statement gave us three main things to chew on. First, they gave with one hand and took away with the other. They said, hey, we're making progress on inflation, but immediately followed up with, but it's not enough. That's a classic Fed move, just managing expectations. Second, they made sure to mention risks to economic growth, which is their way of saying, yeah, we see a potential slowdown. But it's that third point, that's the one that really matters.
This phrase, we will remain data dependent, this is everything. It's basically the Fed's get-out-of-jail-free card. It means they're not committing to anything. They're going to react to new numbers as they come in. For the market, this is code for one thing, flexibility. And that's the absolute key to figuring out what they're going to do next. And that leads us perfectly into our second section, decoding the real signal. This is where we go beyond the official press release and really start to analyze what Fed Chair Powell's tone and his emphasis are actually telling us.
You can think of it like this. The official statement is the script, right? But the real performance is Powell's press conference. Smart investors know you have to watch both, but they put a huge amount of weight on the performance, because that's where you find the real message.
So what do we see this time? Well, three subtle but really powerful shifts. First, Powell's tone when he talked about inflation was just noticeably softer than it has been. Second, he kept emphasizing the word stability, which signals a move away from those aggressive, shocking moves. And, maybe most important, he completely avoided that hawkish, aggressive language about future rate hikes that we've been hearing for ages.
So here's the bottom line. When you put those little cues together, the market reads it as a crystal clear signal. The Fed is getting ready for a change in direction, what everyone calls a pivot, even if they won't come right out and say the word just yet.
Okay, so if the Fed is hinting at a change, how does the market usually react? Well, history gives us a pretty clear roadmap for what you could call the 30-day ripple effect.
Yeah, it's not like flipping a switch. The market goes through a whole process. In the first week or so, expect things to be choppy while all the traders and algorithms try to figure it all out. Then, for the next couple of weeks, things start to calm down as everyone kind of agrees on what the Fed really meant. And then finally, by about the end of the month, the clarity usually returns and a new, more stable trend starts to form.
So, for the stock market, what's that mean? An initial bumpy ride? For sure. But once that dust settles, the historical patterns are pretty clear. The sectors that are sensitive to interest rates, like growth and tech stocks, they often lead the charge as that new trend really takes hold. Over in the bond market, you'll see yields, which might have been jumping all over the place, start to find a new, calmer level. And this happens because the traders are all adjusting their bets on what the Fed is going to do months from now. And that creates a more stable vibe and a clearer story about the future.
And what about the US dollar? Well, any little hint of future rate cuts usually puts some downward pressure on it. Now, this is generally a great sign for global markets and for any US companies that sell a lot of stuff overseas, because it makes their products cheaper for everyone else to buy. And finally, for those riskier assets like crypto, this kind of environment can be like pouring gasoline on a fire. See, lower rate expectations can trigger what we call a risk-on mentality, which just means investors get a little braver and more willing to bet on assets with higher potential rewards, like Bitcoin. Okay, so if the market is shifting, where is the opportunity? Let's zoom in on the specific sectors that, historically, do really well when the Fed starts signaling a big change in direction. These are what you could call the early movers to keep an eye on. Tech and AI are super sensitive to interest rates, so they often get a boost first. Financials can do well once the interest rate picture gets less cloudy.
Small-cap stocks, which have been getting hammered by high borrowing costs, tend to rally really hard. And like we just said, those riskier assets like crypto and blockchain can get their mojo back.
And this brings us to the most important part of all, the playbook. Because knowing all this is one thing, but how do smart investors actually position their money? Here's a pretty simple 5-step framework. First, add your exposure gradually. Don't just go all in at once, because trying to time the exact bottom is pretty much impossible. Second, watch bond yields even more closely than the speeches. The bond market often sniffs out the real story first. Third, use that initial volatility to your advantage. It's a chance to average into your favorite positions at better prices. Fourth, focus on quality. Companies with real actual earnings are always more resilient. And finally, number 5, always keep some cash on the sidelines. Why? Because these market shifts often create amazing, unexpected buying opportunities, and you want to be ready to pounce.
You know, this really gets to the heart of it all. The Fed doesn't actually control the market. Investors' psychology does. And based on all the signals we're seeing, that psychology is already starting to shift. The real key is being ahead of that shift, not chasing it from behind.
So that leaves us with one final, really crucial question to think about. We've seen the signals, we've walked through the historical playbook, the market is shifting. The only question left is your strategy ready to shift with it?